All right, everyone. Welcome to the May 17th, 2023 NYCERS and BERS joint investment meeting. Ms. Winery, will you please call a roll for NYCERS trustees, and then will BERS trustees and staff please identify themselves for the record.
Great. Good morning. Chair, Mayor's Office.
Brian Berge, representing Mayor Eric Adams, present.
Comptroller's Office.
John Dorset, designee for Controller Brad Lander.
And I see that Allison Hirsch is also signed on.
I am, but Dorsa is the lead today.
Sounds good. Thank you, Allison. Public Advocate's Office. Borough President Manhattan. Borough President Brooklyn.
Karina Lozada, representing Borough President Antonio Reynoso.
Borough President Bronx.
Janet Peguero, representing Bronx Borough President Vanessa L. Gibson.
Borough President Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President Staten Island.
Dan Master for Staten Island Borough President Vasella.
International Brotherhood of Teamsters.
Ruben Torres, Lawrence Bosley, and Julie Kobe for Teamsters Local 237 President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TWU Local 100 President Richard Davis.
And District Council 37.
Henry Garrido for Henry Garrido and
Okay.
Ray.
Great. So we have Henry Garrido and Ray Santander for District Council 37. We have a quorum.
All right, and will the trustees and staff of BERS please identify themselves for the record?
Sandy Rich, Executive Director. Do you really want us all to identify themselves individually?
Are there a lot?
No. I mean, we're represented by Allison Hirsch, John Dorsa, Greg Faulkner, and Russell Buckley. Trustees or alternate trustees. Staff and consultants are on. And we do not have a quorum. We'll administer this business at our executive committee meeting tomorrow afternoon.
All right, that does the trick perfectly, Sandy. Thank you.
Yep.
All right, I believe we have a couple of matters for executive session. Melanie? I mean, sorry, public session. My mistake.
Yeah. Melanie, would you like me to hop in?
Sure.
So we have one item that relates to NYCERS that we're going to do after the meeting in a public session, which is a budgetary item. And then we're going to do a joint presentation from the Bureau of Asset Management on the strategic asset allocation market assumptions. And we'll turn it over to Steve Meyer for that introduction for both the assumptions and also for the introduction of the BAM staff. So Steve, we'll turn it over to you.
Great. Thank you, John. Good morning, trustees. As John said, we're going to give you a quick update on where we are on the strategic asset allocation review. Remember, this was initiated at the beginning of the year following passage of the basket clause increase, that legislation that increased the basket clause from 25 to 35%. So we're actually making wonderful progress. We've had a number of calls with Bud and his team at Callan. We actually had come up with some ideas around expectations for considering different thematic issues in terms of this whole process. We then spent time with each of the 5 plan consultants to understand their assumptions that underlie the assumptions. We've then taken that information and put it into a format where we can actually reflect to you trustees the various assumptions around expected returns and correlations and risk across all the asset classes. So we want to provide more details, a little bit more historical perspective as well. And actually, Ed Berman is going to take you through what we hope is a very informative and value-added slide deck this morning. So with that, I'm going to turn it over to Ed. And I think he can share his screens.
Thank you, Steve. Good morning, everyone. And, can we have the slides on the screen, please? Thank you. Can we have the first page? Okay, so what you see here on the screen is the current NYCERS asset allocation, and I hope it doesn't come as a surprise to anyone. You have 3 main buckets: there's private equity, public equity, public fixed income, and alternatives. which is further split into asset classes. So this asset allocation was established back in 2018. It was implemented in portfolio by BAM and consultants around end of the Q1 of 2019. So why are we looking to change that? There are really two main reasons. First of all, as we all know, the past few years were transformative, right? So we clearly had once in 100-year events. We had a pandemic, we have war, and that created an enormous distortion into markets, into the economy, right? We saw very unusual patterns in terms of volatilities, in terms of correlations, in terms of returns. And it's probably fair to say that we're still living through the aftermath of this impact. It will probably continue for a few years to come. So that alone would have been enough of a reason to review the SAA. And it's probably fair to say that most of the public pension systems are going through this process right now. Of course, on top of it, we have another event. We have the change in the basket clause. Again, that's widely well known by everyone. The basket clause was relaxed from 25%. And just to remind you, the basket clause constrains us obviously on the private equity, private credit, but also a range of other assets count as basket clause, in particular, any foreign equities or fixed income instruments, public equities, fixed income, to the extent they exceed 10% allocation counts as basket clause. The same goes for the domestic high yield. Also, anything over 10% counts towards basket clause. And the real assets, as defined as real estate and infrastructure, to the extent they go over 10%, goes to basket clause. So this extra 10% of breathing room gives us an opportunity to find better opportunity, better mix of assets. And of course, our goal is to provide for the minimum hurdle 7% return with the minimum volatility, minimum risk, and hopefully it will be more than 7%. So what is the strategic asset allocation? We touched upon this last time, so I'll just briefly mention 1 minute. There are really two steps to the asset allocation process. The first step is to formulate the capital market assumptions, which is the projected returns and the risks over the next 10 years. The second step is more of a statistical procedure when we use an optimizer to come up with the best blend of assets that will produce the best return with the lowest risk. So at this point in time, we are wrapping up the first step of the process, the capital market assumptions. All 5 systems completed the initial review. We had discussions with all 5 consultants. And what we want to present here today is a little bit different. So normally we talk about the NYCERS portfolio. Today, we're talking about all 5 systems combined. So there will be really 3 parts to this discussion. First of all, we'll take a look at the assumptions from 2018, implemented 2019, and we'll see how these assumptions lined up against the realized return. The second step of the presentation, second part, we will look at the 2018 assumptions, compare with the current assumption from 2023. And finally, in the third and last part, which is probably the most interesting, we will look at the dispersion across the consultants. What is the difference between the systems? And that's a good place to discuss the outliers, the assumptions, and what it means for asset allocation. So with that in mind, let's just dive in.
Ed, before you dive in, let me make one comment as well. The idea is to share information with the trustees. No one, and my teammates are tired of me saying this, but no one has a crystal ball. No one knows what the actual outcomes will be over a 10-year horizon, or shorter for that matter. It is really more to bring the full power of everyone that's been looking at this challenge within the context of the basket clause and that same 7% return assumption. So the idea isn't to ask Callan or Rokaton or NEPC or any of the other consultants to change their views. It's really informational to try to understand the process they go through, these assumptions that underlie their assumptions, And hopefully that makes us smarter in the strategic asset allocation decision overall. So again, the idea isn't to ask anyone or require anyone to change their outlooks or expectations. And with that, back to you, Ed.
Hey, sorry, I just had a question really quick, y'all, if that's okay.
Sure, Brian.
So I'm just looking at this chart, and it occurs to me that this breakdown between public equity, public fixed income, and alternatives of 26% is not the same, or probably is not the same as an analysis of how much of the basket clause is used under the current allocation.
That's
do you
right.
have a sense of what the asset allocation is relative to what had been the basket clause? What percentage?
Well, this is the current asset allocation, Brian. If I'm answering the question correctly, you're asking us what the utilization of the basket is currently under the current allocation?
Yes, that is what I'm
I
asking.
don't have that in front of me, but it's anywhere between 20 and 23% on average across the 5 plans.
Okay, and just rough cut, which of the categories and alternatives do not fall under the basket, and do anything in the other categories, public equity and public fixed income, actually fall into the basket?
Great question. So private equity and private credit do fall within basket. Core, non-core real estate and infrastructure, there's look through of those structures to the real assets. So they typically, and there might be some rare exceptions, but they typically don't draw basket utilization. Non-US equities, as Ed described earlier, developed ex-US and emerging market. And you can see in that allocation that there is a 17% allocation on a target basis on the lower right-hand side of that slide. 10% and above. So the first 10% is not using basket, but the other 7% is. If there was a high.
So it's roughly the 8 for private equity, the 6 for private credit, and the 7% above 10% that constitute the basket utilization. All right, thank you very much. I really appreciate that.
Not at all, Brian.
Okay, so can we have the next page, please? Okay, so let's start with looking at how the previous asset allocation, 2018 asset allocation, worked out against the realized performance. So what you're looking at the charts at the top, you see the charts by the asset class for the returns. At the bottom row shows the volatilities or the risk levels. And one huge disclaimer is obviously it's been only 4 years since the last asset allocations. The assumptions were formulated for 10 years, so we're not even halfway through this process. So it's a huge disclaimer. So history may play out differently. That said, yes, and so the gray bar on the chart represents the asset allocation. I'm sorry, represents the assumptions from 2019. The light orange bar represents the index return, which is the strategic benchmark return. And the brown bar represents the actual return based on the managers. That's the actual return earned by the system. So first thing jumps from this page, look at chart number 1 in the upper left corner. So the assumptions for equities were very conservative. Or put it the other way, the realized return on the equities were enormously high. To put this number in perspective, so you can see for the US large cap, the S&P 500 realized 18.5 return. Just to put it in perspective, the long-term return on US equities, 100-year return, stands around 7.5%. So it's a truly extraordinary returns. Remains to be seen if they will be repeated. That said, it's probably good news that the realized performance did the expectations. For emerging markets, there was more of alignment. The predictions were reasonably in line. But if you look at the risks, that's what gets interesting. At the bottom chart, chart number 3, the realized risks for emerging markets were actually much lower than assumed. And that's important for asset allocation because the high assumed risk disadvantaged emerging markets in terms of allocation. It's also interesting to notice that the realized risk for emerging markets was actually lower than the realized risk for US large cap. And that's mostly because of a large technology representation in the US market. On the fixed income side, chart number 2, you see very disappointing performance of US core, US fixed income. And again, that's not surprising, given that we're going through once in, I forgot how many 100 years, at least 200-year event, but it's truly extraordinary time for fixed income. Something hopefully we'll never see in our professional lives again. But the returns of fixed income were negative versus the 0.4% assumption, and the realized risks were materially higher than expected. And finally, high yield on the right-hand side. One thing I'll be coming to this theme over and over again is how predictable high yield was and how predictable it is. So you can see among all asset classes, it's probably lined up the best in terms of returns, in terms of risks, assumptions versus the realized outcome. And finally, the last point that jumps at me from this chart is your manager performance. It was hugely positive. It was very helpful. In the US large cap, we have mostly passive allocation, don't expect much outperformance. But look at the developed world ex-US. Look at the emerging markets. These are material outperformance by managers. You look at the US core, it's almost a 1% outperformance. High yield. This is a very positive result. It's very encouraging. Moving on to the next set of assets. Can we have the next page, please? And here we're going through the same exercise for the alternatives. And again, the broad picture is very similar. So you see that the realized returns exceeded expectations. I focus less on the benchmark performance on the light orange bar, and it's simply because the benchmarks for private equity, private credit are not that representative. So we're using public proxies for private markets. That said, the assumed returns back in 2019 were higher than in public markets. The realized outcome, again, beat the assumptions and provided a slight premium over public markets. Need to be a little bit careful about the volatility, assumptions of realized volatility. So you can see a huge disconnect. Looking at chart number 3, the assumed volatility for private equity was 26.5%. The realized volatility was 10%. And it's simply because the volatility is in a way managed by the private manager, by the managers of private equity. It clearly moves to a different cadence from public markets. There is no daily mark-to-market. So the valuations tend to be more stable. And therefore, they may not be the realized volatility may not be a truthful representation of the risk profile. We also show in chart number 1 hedge funds here. So obviously NYCERS has no allocation to hedge funds. We show it here as a point of comparison to just keep it in focus as other systems have allocations to the hedge funds. And finally, on the right-hand side of the page, chart number 2, private credit. Again, I want to draw parallels to high yield. You can see that the returns were fairly predictable. The returns of private credit lined up well with the assumptions, and private credit provided a material premium over public markets, over high yield. Core real estate provided an extraordinary performance, which is probably more than anybody can expect. What's interesting that the outperformance of core real estate was much stronger than non-core real estate. And that's probably something we cannot really expect to continue going forward. So moving on to the second section, can we have the next page, please? So here we're looking at the comparison of assumption from the previous vintage to the current 2023. So the gray bar on this chart shows an average of assumptions from 2019. The black bar shows the average of assumptions from the current vintage across all 5 systems. Starting with public equities, chart number 1, what we see here is more of evolution rather than revolution. They're not big fireworks. So the assumptions for US large cap came slightly higher. The rest of them, let's call it about the same. The situation is quite different on the fixed income side, and that's chart number 2 and number 4. So you can see here that fixed income be priced to a much higher level. The yields are much higher, and therefore the expected returns are much higher as well. So going forward, you may expect fixed income to play a different role in the portfolio. And it's true about all asset classes on the fixed income side, from US Treasury to high yield. Here again, just to point out, we show EM debt. It's obviously not part of the current allocation, but we show it just to give you a better picture, better understanding of the fixed income universe. And also on the risk side, clearly, it's repriced to a high level. And that would be consistent with what we see in the markets today. The risks of US Treasury are priced materially higher than before. Same goes for US core. High yield, again, not much of a change. Again, I'm pointing out how predictable the outcomes are. And finally, I just want to put these returns in a historical perspective. Like, are these big numbers? Are these small numbers? To give some intuition over the levels. So you can see US large cap, chart number 1. So went from 5.8 to 6.7. Which is consistent with a fairly high returns we realized recently. So longer term returns for US large cap stands around 7.5. So we're still a little bit conservative on the assumption side. For developed world ex-US, the picture is actually quite different. So the long-term returns for this category, for this asset class, is 5.9%. So that's why we tend to be a little bit more optimistic. And finally, emerging markets, again, the long-term performance is about 6.8%. So again, a little bit on the high side versus long-term history. But again, these assumptions are 10-year assumptions. The numbers I just quoted, you refer to like 50 to 100-year performance. All right, moving on to alternatives. Can we have next page, please? So the same exercise for the alternatives. And again, what strikes me here is how consistent everything is. Right, so you see that the levels change slightly, but there are really no big takeaways. Broadly speaking, everything is in line. Private equity, slightly high return assumptions. Core real estate came slightly down. Again, consistent with a fairly outstanding performance of this asset class. But the main takeaway, no huge changes on the alternative side. All right, so the next part is probably more interesting. Can we have next page, please? So now let's move into the dispersion across the systems. So here we bring all 5 consultants into the picture. And we start with the fundamental building blocks, with the macro assumptions. So obviously, the capital market assumptions formulated across all asset classes, but the assumptions are not equal. They're more important, less important. So the most fundamental assumption in the current environment is inflation, chart number 1. And you can see that there is a really broad agreement on the long-term path of inflation. All 5 systems see that inflation is coming down. Longer term, it's moving close to the Federal Reserve target of 2%. And the dispersion is between 2.3 to 2.5%. Let's call it not material. This is not surprising, given that the inputs, the basis for analysis is very similar across all 5 consultants. That is the dot plot published by the Federal Reserve every quarter, and the forward Fed fund curves. So given comparable inputs, the results are fairly similar. It gets more interesting when we look at the cash assumptions, chart number 2. And cash, again, is another fundamental building block. So given that inflation assumptions are similar, you would think that the assumed cash returns would be aligned as well. Clearly, it's not the case. So you can see chart number 2, Callan, your consultant, came probably on the low end of this range. You may ask, why is there such a big difference? The answer is it's all about the path. So Obviously, the cash returns, cash rates now are very high. It's how we transition from today to the low rate environment 10 years from now. If you expect the decline to happen faster, you end up in the Callan's assumption. If you expect it to take longer, it's more like Wilshire and ABC. Just to put this in my perspective, if you look over long term, the cash returns tend to be around or slightly lower than inflation rates. So from this perspective, I would say that the Callan's returns, Callan's assumed cash returns, are probably more in line with the observed historical performance. And finally, chart number 3, US Treasuries. Again, that's the third fundamental building blocks that goes into valuation for asset classes. Different from cash, you would expect, given that the huge dispersion in cash will be the same for Treasuries, not really so. It's broadly in line. And it's really based on the forward curve, which is observable. Maybe Callan, your consult came slightly down, but it's not material. Let's call it broadly the same across all systems. Moving on to the individual asset classes. So as we saw on the first page, asset allocation, by far the largest allocation and the most important asset class from the return perspective is US large cap, US equities. Chart number 1, you see a big dispersion. That's probably one of the most surprising outcomes for me. The range of assumption between 5.4 for NEPC to 7.7 to Siegel Markov. Callan again comes almost right in the middle, not just in terms of returns, but in terms of risks as well. You can see at the bottom, chart number 4 for US equities. Callan is exactly in the middle of the range. I would say the same holds true for the developed world ex-US, chart number 2. So I'm not going to do all of this. It gets more interesting for emerging markets. First of all, the spread is much wider. The spread of risks is also much wider. Again, Callan is probably more in the middle. And the outlier here is actually NEPC. So you can see that the assumed returns for emerging markets are higher than for developed markets. And also they assign much higher risk level. So we're clearly an outlier. But in terms of a NYCERS portfolio, I would say we're like in the middle of the pack. Moving on towards fixed income. Next page, please. Thank you. So US tips. It's not a huge allocation, but it's obviously an interesting allocation given the current environment. Chart number 1, surprisingly uniform. And surprisingly, given the uncertainty about the path of inflation, that's probably a curious outcome. There's broad consensus both on the returns, chart number 1, and on the risk levels, chart number 4. If anything, Callan slightly down on the risk side at 5.3% versus the average 5.9%. But again, these are not huge numbers. I wouldn't call them outlier. US core fixed income, chart number 2 and 5. Again, very similar, broad agreement across all systems. Callan, your consultant, is exactly in the middle of the range. And finally, high yield. One point I think to point out is chart number 6. A fairly high level of risk assigned by Callan to high yield. Why it matters, once we put all these numbers into optimizer, it will probably disadvantage high yield from the asset allocation perspective. Again, we're not talking about huge numbers. Nevertheless, it's a slight difference. Okay, moving on towards alternatives. Next page, please. Thank you. Private equity. Broad agreement on returns. Maybe Callan came slightly lower, but again, it's probably private equity looking forward 10 years. I would say probably one of the most difficult asset classes to forecast in the current environment. The risk levels are actually interesting, chart number 4. So obviously, if you look at the observed volatility of private equity, you'll end up at a very low level, around 10%. You see numbers much higher than that. You see numbers that are higher than public markets. And why this is so, I think there's a broad agreement across all 5 consultants that volatility, we use volatility as a proxy for risk. And as such, the observed volatility may not be a proper capture of risk. So what the numbers you see here is the result of the model and the results that kind of pull the volatility a little bit higher to reflect the true risks of the asset class. And you can see that there's a fairly broad range of assumptions. Rakuten came materially lower. Callan is probably closer to the middle of the range. There's more disagreement for private infrastructure, which I personally found a little unusual, given that it's a fairly predictable asset class, stable asset class. You can see that Rakuten is very bullish on private infrastructure. Callan maybe slightly lower, but let's call it about average. Probably more interesting to me is Wilshire here, which is obviously not your consultant. The return assumptions are lower and the risk assumptions much higher. And again, hedge funds are shown here just as a point of comparison. NYCERS obviously has no allocation currently, but you can see that across all 5 consultants, this very broad consensus in terms of risk and returns. Especially this is a point of reference only. And we've been talking so far about the general consultants, but let's bring the specialists into the picture. So can we have the next page, please? And of course, the specialist consultants are responsible for individual asset classes, for private asset classes, and they do not typically provide asset allocation. You can see that their view of the world is actually quite different. And probably not that surprising that they see the returns more bullish. The return assumptions are higher than average. The risk assumptions, it varies from consultant to consultant. Stepstone uses just observed volatility, which is 10.7%, which is discussed. It may not be a proper measure of risk. Hamilton Lane makes adjustment, XC makes adjustment as well. Nevertheless, the risks that specialists see in the private equity is materially lower than the general consultants. We had a number of discussions when we brought specialists and generalists together. Let's just say that we'll agree to disagree. And I think the main point to make here is the general consultants look at it from the point of asset allocation, from the portfolio construction, which is a quite different angle. Okay, and moving on to the second set of alternatives. Starting with private credit. Again, the same theme that I keep mentioning about predictable nature of credit, be it public high yield or private credit. You see very little dispersion. And you see little dispersion for returns and for risk as well. So very predictable asset class. Obviously, private credit offers a material premium over public high yield. Core real estate, more uncertainty. Right, again, we mentioned before the returns over the past few years were extraordinary. Some consultants see reversion to mean, some consultants see continued outperformance. Again, Callan, your consultant, is exactly in the middle of the range, which will give you some comfort. Again, for non-core, on average, the projection is for some premium, high returns, high risk. Again, there's no broad consensus. You see NAPC sees the world very different. But again, what's important for NYCERS, Callan is in the middle of the range. And again, to bring the specialists into the picture, the next page. Thank you. Again, the same thing. You see the specialists see the world as alternatives providing high returns with low risk. I would say in case of real estate, the difference is not as wide. It's a little bit more in line, but again, on average, you see the specialists see the world slightly different. Okay, and finally, excuse me, finally, to bring it all together, and we have next page. Sharp ratios. So we talk about sharp ratio. Sharp ratio, of course, is just the excess return divided by the volatility. Sharp ratio is important because they kind of bring everything together. They bring together the risks and the returns and risks. And ultimately, the optimizer, which is the next step of asset allocation, goes by the Sharpe ratios. So I will prefer higher Sharpe ratio asset classes. And again, it's important to keep in mind that high Sharpe ratio is not necessarily the best asset class, because high Sharpe ratio comes a broad range of risks. The other point to keep in mind, so far we talked about dispersion between the systems across the consultants. When we look at the Sharpe ratio, what's important is to look at the consistency of Sharpe ratios within each system. It's the relative Sharpe ratio that's important. So let's just take a look at these numbers. So you can see that these bars jump up and down much more than before. And again, we'll talk about ratios. Let's start with US large cap. So on average, the Sharpe ratio, the projected Sharpe ratio of US large cap is 0.19. To put it in historical perspective, if you go back about 100 years, the long-term Sharpe ratio of US large cap market stands at about 0.37. As a matter of fact, it's a curious point that Sharpe ratio of almost all asset classes, long-term Sharpe ratio, stand about the same level, about 0.37. Over long term, like 100 years or so, Sharpe ratio is converging. Of course, we're talking about 10 years. And you see this a fairly broad dispersion. Looking at chart number 1, NEPC, I see it maybe more in negative terms. Callan comes with 0.25 on the high end of this range, but probably closer to the long-term Sharpe ratio for US equities. Exactly the same goes for developed world ex-US. You see the same trend, and again, Callan probably on the higher end, maybe less US equities, but nevertheless. Emerging markets, even though the average of emerging market Sharpe still stands at 0.19, you see more of dispersion. So from your point of view, from your portfolio, looking at the between US large cap, developed world ex-US and emerging markets, the optimizer will probably look less favorable at the emerging market equities. And it gets more interesting for fixed income. Again, not surprising, given all the calamities happening in the fixed income market right now. Look at chart number 4, US tips. That's a wild chart. Remember just a few minutes ago, we talked about broad agreement across consultants on the US tips. It looked like the returns and risk assumptions were about the same. The catch is that the assumed return on the US tips is almost the same as the return on cash. It's about 4%. And once we divide small number by small number, the results may be quite different. Actually, the range is Callan 0.24 to Wilshire negative Sharpe ratio. It's a broad range of disagreement. That's it's a fairly niche allocation. It's, I believe, about 3% for NYCERS, but nevertheless, it's clearly an outlier. Even more of an outlier is US core fixed income, chart number 5. And that's where probably the only place I would say that Callan is clearly on the high side. So Callan sees US core fixed income. Again, it's not a point of criticism or otherwise. It's an observation, but the Sharpe ratio for US core is higher than the rest of the systems, which means that the optimizer will look more favorably at this asset class when selecting the best allocation. And finally, high yield, chart number 6. Again, the same theme I keep going back over and over again. So you can see that the average Sharpe ratio of high yield, 0.26, is the highest on this page. And also it shows the least amount of dispersion across all 5 systems. Maybe Callan came on the high end, but in all honesty, the difference is so small, like alternate material. Again, it's the predictability of this asset class that jumps at me. And finally, I want to look at the private assets, the alternatives. So again, the next page. And that's a wild page. So first of all, I would say probably Sharpe ratio is not the best way to think about alternatives. And it's simply because volatility is not well defined. But for private assets, that's how if you look at chart number 1, where assumed Sharpe for the specialist push the parity of 1 point. Your private infrastructure stepstone assumes 1.24. I wish we could have these Sharpe ratios. I'm a little skeptical. So let me just leave it at that. And before I finish off the question, just one point I want to make. So there are 3 parts to capital market assumptions. We talked about the return assumptions. We talked about the risk or volatility assumptions. The third piece are correlations. So I'm not going to go into these details, but we'll provide more details in the appendix. If that question, I'll be happy to cover it. There's a material amount of dispersion across the systems. You won't be surprised to hear that. And of course, it may have material impact on asset allocation. So, and the next step in the process, of course, is we talk to all consultants. We'll be running, the consultants will be running the optimizer. We'll be discussing it, and then we'll have a chance to discuss the allocations, potentially looking at some other asset classes, and potentially is the key word here. Obviously, we're not starting from blank page. We expect to continue on the process. It will probably more of evolution. We're not looking to re-engineer the process, but it's a good point in time to have a holistic view of the portfolio, to look at the most optimal allocations, and just discuss some implementation questions with consultants. So I'll stop here and open for any questions.
If it's appropriate, Ed, and not a question, just a comment. Bud, you may want to comment as well. I know you've been. We appreciate your partnership through the process and your openness with you and your colleagues in terms of the assumptions and how you derive them. Any comments, Bud, that you have on the process or observations?
Well, first of all, Ed and Steve went over this with us a week or so ago, and we think it's a good exercise to see how we compare and contrast to the other consultants. Overall, we think we're pretty much in line or kind of down the middle when it comes to the assumptions for the various asset classes. Maybe 1 or 2 were at the high or low end. You know, we build our capital market assumptions once a year with a 10-year horizon. So when you looked at section 1 of Ed's presentation today, those were only, 3 years in or 4 years in. So we still have a ways to go before we see how those 10-year projections from 2018-19 look over the next few years. We're happy to take any of your comments or observations into the process as we look to optimize portfolios. But we'll also probably make some minor tweaks to the alternative asset classes as far as our risk and return. We've already had the discussions with the alternative consultants, and given that they implement a little bit different than our average client, we'll probably have some minor adjustments on the risk and return for the alternatives. But we expect to keep the public market assumptions just what you saw.
Terrific, Bud. Thank you.
Sure.
Hey, Steve, I don't know if there's questions, but do you want to comment on timing and what you're thinking about as far as timing for the next time this will come back to the boards and things that folks, if they have questions, what's the time frame for them to kind of throw those at BAM and at the consultants?
Sure, John. Thank you. I think Ed touched on it earlier in terms of the next step is for talent to do what they do, to run their optimizations and look at the outcomes. And we'll have conversations with them as a result. And at some point, hopefully, and I don't want to speak for Bud, but in either June or July, perhaps, probably July is more realistic to come back with specific insights into that optimization process. The hope and expectation is that we can get everything to the boards for discussion and approval by September and maybe, get finalization for October. We'd like to incorporate, assuming there might be some changes to the private asset allocations, again, associated with the change in the basket clause, that there might be an increase or changes in the allocations, which we'd like to incorporate into our pacing plans for 2024 and beyond. So that's the hope, is to get this wrapped up by, say, the end of October.
And is it safe to say that if there are questions between meetings, BAM is available, and I'm sure the consultants are, to address any of those questions that folks have? This is the most important decision that we make as a board with respect to investments. So I don't think it's something that any of us take lightly. So I just want to remind everybody we have resources, and that all the trustees should be comfortable with the discussions that we have and with the outcomes.
Absolutely, John. Thank you. I know Ed threw a lot of information at you and a lot of insight. Any questions for anything he covered, or?
So if there's no other questions regarding the strategic asset allocation and the
Sorry, John. I think
Henry
we have a
Garrido.
question from Henry. Yeah.
And I'd also like to reflect for the record that Elizabeth Guzman, representing Public Advocate Jumani Williams, has joined the meeting, and Robin Roach has joined with Executive Director Henry Garrido and Ray Santander, who is already in the meeting.
Great. And with that, I want to recognize Henry. He's had his hand up. Apologies, Henry.
Thank you, John. This may be out of line, but I wonder how much of this process we can make available for the sake of transparency, because, given the lawsuit that has been recently filed and this whole idea that we're with these crazy liberals sitting here trying to gamble with people's money, what you have just presented to us is incredibly valuable, right? Because it goes to the whole idea of not just how the sausage is made, but that we actually thinking about the ingredients going into it. That it's not just sitting around and say, okay, what is this particular asset that we can tinker with to align with the social policy? When in reality, what you're looking at, what we're looking at, it's as you said, John, probably the most important decisions that we made, because we are, as fiduciary, responsible for people's money, right? And so I know that a lot of this information is confidential, obviously, right? We are trustees and as such respect to do that. But I wonder if we could let ourselves at least be somewhat transparent, more transparent in the process by which we select this, either at the back end of the process when we do it, or somewhere in the process as we deliberate this conversation. Thank you.
So Henry, I just want to note, we're in public session now. Our intention is to have a majority of these conversations regarding strategic asset allocation in the public domain, so that people do see that we're having a thorough process, and that trustees are asking questions. And I think that you raise a very good point, which is we should be transparent about the process. There's nothing to hide here, and this does affect a lot of people, these decisions that get made.
Yeah, I appreciate that, but I think I'm suggesting something even further, which is to say, not just expect, I'm sorry, Alice, not just expect that whoever is going to join for the sake of looking at, I think there's a slant, there's been a slant on some of the parts of the media, and I believe this has even made it to the whole conversation. I know the controller was at a debate recently, and I have a suspicion this is going to make it to the national debate as we run to the presidential campaign, that if we are closer and more intent in putting this information, or at least the process out, that we are not just expecting people to assume that this is, they're going to logging into a meeting for an hour and a half or something and make heads or tails of this stuff. But at least the deliberation part, I think, is important. And I don't know that we do a good enough job of talking to the people about the work that goes behind the process of selected investing and safeguarding the retirement security of many of our members. Thank you.
So I just want to jump in. It's Allison. Thank you, Henry. I want to say I agree with you on that last statement, and I know the controller does too. And we've had some beginning conversations about how we can sort of like go behind the curtain. I have this image in my mind of like Steve doing, a Robert Reich like video on the whiteboard, like walking through what is an asset allocation process and how does it work, and like putting it out there for beneficiaries and on social media, et cetera. And I know that the press team in the controller's office is really thinking through how to, obviously with your permission and the permission of the boards, like really try to talk a lot more publicly about what this process looks like and what the deliberation process looks like. Yesterday, you may have noticed, we can circulate this. Brad posted on social media about to follow up on the mammogram that Steve sent last week about how the investment staff is preparing for the debt ceiling and making sure that we have liquidity in the funds, et cetera. So I think your point is very well taken and important, and something that we're working on. And if folks have ideas about audiences or places that Steve or Brad, whether it's membership meetings or, public places we can talk about this stuff, I think we'd love to have a roadshow.
Allison, can I ask you a question around that area? Do you envision the control's office, does it envision that if the target audience is not just the New York Post, but that the target audience is obviously the people that we represent, both active members and retired members who may be concerned about where this is going, that should be the target audience, and that to the extent that we just send a statement and say, here's a basic Q&A on what has done and the trustees have done, that we do that like overtly, that we do it in a way that it is, proactively, that we don't expect, so that they hear a different version of what's out there. Because what's out there is all negative and we're gambling and this, and then undoubtedly you attach identity politics to a process that has been, almost sacrosanct, like that we have really taken serious, and that we need to let both retirees and active members know that we're not just sitting here on the floor of a casino of the pension Caesar Palace. It's going, oh, well, we're gambling on this because it's not our money. It is my money. I am a pension member. You know what I'm saying? Like, yeah. that the intent is to go to the members and to the retirees and say, here's what we're doing to safeguard your money. It may be difficult to understand an asset allocation of another one and what a basket clause is, but here's the essence of it, right? And to that would be something that we communicate rather than wait for, sort of like expect that the media is going to get it right in the first place.
I would go one step further, Henry, and say the audience is definitely not the New York Post. Like they have a frame, and they're going to have their frame no matter what we say or do. I mean, they write an op-ed every week against Brad. The audience is 100%, as far as I'm concerned, the members of this system, beneficiaries. And so I would say, and so like, for instance, this is a different system, obviously, but the UFOA invited Steve yesterday to speak at their retirement seminar to talk about the work that BAM is doing on behalf of the fire pensioners. And so Steve went up there and talked and just did a Q&A on, questions they have about the fund, et cetera. I think to the extent that we could do that, Steve could do that at DC 37 member meetings or retirement meetings or 100 local 100 or, Teamsters, have you. I think I'm speaking on behalf of him now, but he will make himself available to do that. I think if there are other ways
Absolutely.
I think we're in the, pension insert, that's the topic for this month, and the pension insert that goes out to beneficiaries. So I would say the more, and maybe it's worth a side conversation to just think about all of the different places members read and members look and members watch, so we can make sure we're targeting any communications appropriately. But I think that's who our audience is and who we want to be talking to.
It's a shame we didn't have this conversation earlier before the suit happened, but we have to be very careful not to put anything out there that would adversely affect the suit as it's going on. So anything you guys decide to do right now, I think should go through legal to be vetted.
It always does.
Good enough.
So are there any additional final comments on the strategic asset allocation before we move into executive? So seeing no hands up or hearing nothing further, I'd like to make a motion that we exit public session and enter into executive discussion to discuss specific investment matters.
I will second that.
Thank you, Mr. Katzman. Brian, you want me to just call this here or?
You invited the motion, John. You might as well see it through.
Oh, okay, thank you. So all those in favor, please indicate by saying aye.
Aye.
Any opposed?
Aye.
Any abstentions? Hearing none, the motion is carried. We will now go into executive session. And Bam, if you could please just let us know when the recording is off.
All right, we're now back in public session. We have one item for the agenda, which I think we should do before the readout, though I defer to you, Melanie, if you'd rather do the readout.
Yes, great. We have one item for the agenda, which is a mid-year budget modification resulting from recent collective bargaining agreements that modifies the personal services portion of NYCERS budget. With the board's approval, it's a short reso. I will read the reso into the record and then the board can move forward and vote on the reso.
If you could just move to the resolve.
Okay, resolve that the Board of Trustees authorizes an increase in the fiscal year 2023 administrative personal services budget from $43,016,069 to $49,971,894 to cover the increase for salaries and associated fringe benefit costs to the NYCERS regular administrative budget for fiscal year 2023 as a result of collective bargaining agreements.
Great, thank you very much, Melanie. Now, we've discussed this extensively, and I appreciate your hard work in getting this budget modification to the board, which really just has to happen. It's what literally has to happen and what is almost certainly going to happen based on past practice.
Right,
So,
and the increases go into effect later this month, so it was timely to get it before the board to adjust for the increases.
So absolutely. I think it's fitting to defer to Robin if she would like to make the motion.
Certainly, if that is Robin's desire, please, Robin, if you would like.
You're on mute, Robin. Or Ray.
I guess Henry has left the meeting? Now, I would defer to Henry if Henry.
I believe he has left the meeting. Doing a scan, I do not see him, Ray.
Okay, and Robin can't.
Yeah, Robin's on that. Robin, you're
just unmuted.
Am I good now?
Yes.
You are great.
Very good. I so move that the budget adjustment for NYCERS be approved.
So I will second that from the controller's office to indicate that we've fulfilled the requirement that the mayor or the controller agree with the budget modification.
I would like to note for the record that the mayor previously indicated his agreement and enthusiasm for the budget modification.
So noted.
That's a co-second. All right, all in favor of the motion, please say aye.
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 Any opposed?
Aye.
I'll assume that was an aye for supporting, not an aye for opposition. Any abstaining? All right, the motion carries.
R2, and many thanks to the board.
So I think we need the readout.
That's right. Thank you.
You go to the report out. You can just hold on a second. I'm flipping through documents. The board agreed to take action on an alternative credit investment, the details of which will be released at a later date.
And with that, I would like to make a motion to adjourn.
I'll second.
So moved. Second, yeah.
All right, all in favor of that motion, please say aye.
Aye.
Any opposition? Any abstentions? Hearing none, the motion carries.
Thanks, everyone.
Thank you all.
So Melanie, I think we're staying on.